Hello guys, in this video I'll try to show you two ways to make your own portfolio, and I will just explain what is this idea of index or mutual fund, because we are speaking about both these three words. Now, in index, let's take an example of index. Okay, index. When you are asking what is it, this index? So an index, it is a collection of stocks, companies that we should keep. We should not change each month or each year. We should change this, but we change it when there is a need. Now this need is when the criteria that you choose a stock or a company, and this company doesn't meet that criteria, you should change it. Now, if we can give you an example of an index, like the Dow Jones Industrial. Okay, so it has how many stocks? It has 30 big companies. Now, when they choose them, it means they put a very rigid criteria on how to choose these companies. These are the biggest companies in the USA and the biggest that make the money. So there are some criteria. That's why they put this 30. Now in the future, 5 years, 10 years, 20 years, 30 years, if one of these companies is not doing what they are supposed to do, they will delete it and add another company. Okay? So this is an index. Now, mutual fund is different, although the idea is the same. Okay, mutual fund. Mutual fund is like a company. It has a name. Okay, it has a name, and in this mutual fund, you will find stocks that a manager choose. Okay, he has some criteria to choose these companies, but understand that mutual fund, he can change each year, he can change some stocks, and there are rules that he should apply. So there are some rules from the SEC, okay, that he should apply. But he for the choice of stocks, he chooses whatever he wants. But there are rules, okay, what to do and what not to do. But still, a mutual fund is a collection of stocks. It can be other things, but majority of mutual funds are stocks. Index also is a collection of stocks, so it's the same. Now we speak about portfolio, which is the same thing as an index or mutual fund. It's the same thing. Now, who manages the portfolio? It is you. Okay? So you can do like a mutual fund, or you do like an index, and you also choose stocks. Okay? And these stocks, the average, or what you get at each day, the average, is your account balance. It means when you go to your broker, let's say you have $11,250. Now this is balance of yesterday. Now today you find the balance. Let's say some of your stocks go up $12,053.65. Okay? So you don't see each stock what it does, but you see always the average. The mutual fund, you see always the average, and the index, it gives you the average. So all these three, 1, 2, 3 have the same thing, which is the average. It means is it going up or is it going down. Now you can make your own portfolio that resembles like an index or mutual fund. So it's not just because you see a mutual fund, you see this thing is very, very big. Now, if a mutual fund has a lot of money, like billions of dollars to buy stocks, and you don't, but you don't have to, okay? You don't have to. You can buy a few stocks from this $11,000, 250. You can buy 4 or 5 or 6 or 7, whatever you want, or you buy 50 shares or 20 shares, and you make your portfolio, and you don't look at the stock itself, but you look at the balance. It means the average. And then after 1 month, for example, you can check it daily, okay? You can check it daily, and you will see that, for example, you begin here, you begin at 11,250. Then let's say you go down a few days. Now it's 10,500. Okay? And then you go up in a few days, which are very good. And then you are in 12,050. So, or 12,500. So here you see that you are making your own index. And this is a chart. You can make even a chart that looks like this, and you can make your own portfolio. It doesn't matter what is inside. The most important that you should look daily is your balance. Are you making money? Yes or no? Okay? So to do this, I propose to you 2 ways to do this. Okay? Now, the first one is, as I do, is what we call swing trading. Okay? So, swing trading, what is it? And what's the difference between swing trading and investing when you want to make your own portfolio? What's the difference? Now, in swing trading, we are following only trends in the market. Trends. Stock, $10, it goes to $20, for example, in 3 months. 3 months. This is swing trading. Just you follow trends in the market. Okay? Now, the only thing that swing trading is that when something is going wrong, you should exit with a stop loss. Okay? Now, why we exit? Because our aim is to follow the trend. Okay? We are not going to continue losing money like an investing do. Okay? Whenever a stock is not doing good, you exit it and you replace it. So let's say in your money you have 1, 2, 3, 4, and 5 stocks. Excuse me. Okay? Now, these 5 stocks you bought, let's say 3 stocks are going up. Let's say 1 is going down, you cut it. The other is going down, you cut it. The other is going down, you cut it. It means you delete. And then these stocks, when you exit them, you just replace them with another stock. Replace. And you do this the whole year. The whole year. And this is what we call swing trading in a portfolio. Now you can do the same, okay? So you begin with 11,250 from the beginning of the year. Now at the end of the year, let's say 31st of December, you should see where, let's say, it in 15,375. With the commissions, with fees, with whatever. So It's all, when you see your portfolio, it's all included, like commissions, like fees, whatever, like dividend if you have dividend. So this is how it works. Now for you, it doesn't matter the number of losers or number of winners. Don't look at that, because that is not something that you can rely on to know if you are making money or no. The most important thing you look at is the balance. Are you making money? Yes or no? So this is swing trading. And in the future, the whole year, 2 years, 3 years, 4 years, 6 years, you are looking just for the balance. Don't look at the losers and winners. Except when you are a beginner, you should know why, and you should get a training and fix that. Okay? Now, what is about the investing for the long run? What's the difference if you want to make an investment like Warren Buffett, for example, or any other investor? What's the thing that you should do? Are you going to do swing trading? It means you stop the trade each few days or few weeks, or you stop and you replace, or you do something else. Now, investing for the long run, it's, let's say you choose 5 stocks, the same thing, but, and you have $11,250 and you want to invest it for the long run. It means forever, not for a few days, like or few weeks or few months, like swing trading. Now here, first you should choose this company, and you try to look at the balance sheet of each company. It means you should look at the balance sheet. It means you should see if this company is a strong company, making money. It has no debt or less debt. It is the best in its industry. If you compare this company with companies in the same industry, it should be the best. It should be one of the leaders. It means the best companies. And you should see that this company is having better earning each quarter. It means it is making more money each quarter or each year, and you can see that. If it gives dividend, the dividend should be going up. Dividend should be going up each 1 years or 2 years. The company give more dividend. Now this is all about investing. It means since you are staying many years, 5 years, 10 years, 20 years with this company, you don't need to see each day what this company is doing. So you can check, for example, an example, each quarter is when we have 3 months, and we have the company announcement about the earning. You can just see if it's doing better than last year, the same quarter, and if it is making more money. Now, the thing here, you should know the companies. This is the most important thing. You should know the company, know this company very well. So here in swing trading, we don't see the company. We don't see if it does so well or not. We are looking for the trend. If the stock from $10, it goes to $20 and it is the worst company in the world, I don't care. Since you double your money, you don't care about the company, how it works, or because this we are following here. We are following the price action. We are not following the company. So try to understand this idea. So in swing trading, we follow the trend. Let's say $10. $20, 3 months. Okay? So since there is a trend, there is money coming to us, we don't care about the company and we don't care about the company situation or whatever. And most of the time, not all of the time, most of the time, companies that are going up, they are doing good, it means there is something good about them. Earnings or better news for this company or whatever. That's why a lot of people, they buy it. Now here, in investing, we are not looking for the price. If it is just going up, we buy it. No, you should dig inside and see the balance sheet. And another thing very important in investing for the long run, we are not going to change companies frequently. We should leave it at least a year, okay, to see. We give the company a chance, 1 year or 2 or 3, and we see if this company, even if the stock is going down, we don't care that much until we see that the company is not a winner. And then we can exit it, we delete it, and change it. But most of the time, you should keep these stocks for many years, and then you see, you begin with 11,250, and then, let's say, after 5 years, you are, for example, at $20,500. Okay? Some of your companies, let's say 3 of them, 3, 4, 5, have done so good, and 1 or 2 have done bad. Now you check this that have done bad, and you check if the balance, it means financial sheet balance, you see what's wrong with these companies. Okay? Is it just a bear market, or is it the whole industry that it is doing bad, or it is just the company that it is doing bad and we don't know? But when we discover this after 1 year or 2 or 3, we should just delete those. So these are 2 ways if you want to make a portfolio as a swing trader or as an investor. Okay? So they are different. Now here in investing, we don't use a stop loss. There is no stop loss at all. You buy and you leave. Okay? But understand that you are risking more. Investing for the long run, you are risking more, because some companies you can lose, let's say 50% or 20% or 30%, because you should bet for the long run. You shouldn't just quit or exit an investment very quick. You should decide good decisions. When you buy, you don't sell again, because it is not trading. This is the difference between when we say trading and investing. It's totally different. Here, trading, we look at the price primarily. Investing, we look at the company primarily. Okay? You can make an investing. Let's say if you have, for example, a Roth IRA, just an example, okay? Or you have, for example, you have an account, and you should not mix 2 of them. You shouldn't put, for example, 5 stocks you trade and 5 stocks you do investing. This is a bad idea. Now, I will tell you why it is a bad idea. Okay? Understand. Let's say if you have one, okay? Let's say if you have one account and you want to do swing trading with investing. You say, for example, just an example, okay? You say, for example, you put 6 stocks. Now, 1, 2, 3 here are swing trading. And you put 1, 2, 3, this investing. You invest for many years. The problem here, okay? You have a problem of tax in the future, because your tax preparer should look for this. You do hundreds of stocks each year, buying and selling, buying and selling, with this 3 or 4 or 5, which is long term, and this will be bad and they will be mixed with each other, and your tax preparer will have problems finding where is the investing, where is the investing stocks, where is the swing trading stocks. It will be hard. But let's say if you have this idea to have 2 accounts. Now this is very serious, okay? It's very serious. Now, let's say you have 1, 2, 3, 4, 5 companies that you know they are strong. You can even put into 1 account. And here, the swing trading, you put another account. Account 1, account 2. Okay? If they are simple accounts, not a Roth IRA, okay? If they are simple accounts, when they do the tax, since this you keep more than 1 year, so your tax is lower than the tax that it is here, which here it is like an income. Because let's say in this account you make $2,000 last year, and here you make $2,000, the same. Okay? Now these stocks here, when you sell them, let's say you sell 2 stocks after 3 years. Now these 2,000, the tax, when you sell them, the tax will be lower, very, very low than these ones, because this is considered as a job. You are making a job like a part-time job or something. It's like an income. So this income goes with your job that you have previously, and 2,000 is added, and then you will be taxed more because your job, let's say you have 40K, just an example, plus $2,000, your account is becoming bigger and bigger, and you will have more tax to pay. Now here, since you are an investor, the IRS gives privilege to investors because they keep their money and don't moving them up a lot, so they give lower taxes. So this you should understand. Now, what if, for example, you have an investing for the long run, okay? And you do what? You do a Roth IRA. Just an example. Understand that in Roth IRA, okay, there is no tax because it's like a retirement. There is no tax. So you can, for example, have, let's say, 5 stocks in this Roth IRA. You just buy them and leave them. And each year you can add more money to buy more shares. More shares. Let's say your companies are going up. This is $20, it goes to $25. This is $10, it goes to $13. This is $70, it goes to $80. Okay? Now next year, when you have your contribution, yearly contribution, you can add money. The maximum is $5,500 for people less than 50 years. Okay? And if you are more than 50 years old, you can add $6,500, but these numbers change. They change each year, so you should ask your broker. Now, let's say you put $5,500, you put them in your account, and you add more shares for the good stocks. And you continue to invest, and you don't pay tax, and all your profit is yours. So this is just an idea how the people are doing not to pay tax, because it's from the IRS, and it doesn't ask you to pay tax because it's retirement, and you can leave them for forever in your account. Okay? So there are many things that you should be interested in. And since you put Roth IRA here, so for your tax, you just get this one, which is a swing trading account, which is as an income. Okay? Because it's very good not to mix both of them. You can put two accounts, either individual accounts. There is no problem with that. And you are investing, you pay less tax as you like. So before you do anything, you should, as you are as you are thinking about your future. I don't know how old are you, okay? But if you are thinking about your future, you should you should make a decision, okay? Make a decision what to do. Because, you know, investing is for the long run, okay? It's not you invest for 1 year or 6 months or 2 years and then you stop. The future, you can't do that in a very, very short time, because you don't see what will happen if you don't stay long. Now, Warren Buffett example, always he said, because he is one of the best investor, so he said that when you invest in a company, it should be 20 years. It means more than 20 years. You should hold the stock. Since you decide that it is a good company, you hold it until you see. If you see that the stock each year is going up, it means you succeed. It means you just leave the stock going up for 10 years or 20 years. Okay? If you succeed in investing. And this is how the money will become double or triple in many years. It means you have 10,000, after 5 years you will find, for example, 50,000, or you have 50,000, you will have 200,000 in 5 years or 6 years. It means that the money will accumulate when the stock are doing better and better and better. Okay? So this is all for how to make a portfolio. Hope you enjoyed the video. Please, if you have question about swing trading or investing, you can just send me an email or comment on the video. Thank you very much.